Hello, this is Dean Malone with Compass FX. This training video is about the structure of the Traders Dynamic Index Pro. The Traders Dynamic Index Pro, also known as the TDI Pro, is made up of 5 lines. Each line has a specific representation that makes the TDI Pro unique. The green line, known as the RSI price line, represents current price sentiment. The red line, known as the trade signal line, represents areas to enter and exit a trade when the green line crosses over it. The yellow line, known as the market baseline, represents overall market sentiment, the prevailing sentiment of traders in the market. The blue lines, they work in concert as the volatility band. The band represents increasing and decreasing volatility in the market. The TDI Pro also has 3 levels. The 68 upper level line, also referred to as the buying exhaustion line. The 50 mid-level line, which represents the changeover from positive and negative sentiment, and then the 32 lower level line, which represents selling exhaustion. So when trading with the TDI Pro green line, it identifies positive and negative sentiment. When the green line is above 50, that is positive sentiment. This is where buyers are buying. When the green line is below 50, this is negative sentiment. This is where sellers are selling. Also, the green line can be used to identify overbought and oversold sentiment. So when the green line gets up above the 68 level, this is where buying momentum will slow and start to fade and reverse. Buyers are looking to exit their trades while sellers are looking to potentially get into a trade short. Just in the opposite, the green line, when it's below the 32 level, this is where selling momentum slows down, where the sellers are looking to exit their shorts and buyers looking to buy at a lower price are looking to get into a trade potentially. Working with thousands of traders over the last number of years, I found that most traders fall into 2 categories: conservative traders and aggressive traders. Conservative traders like to find more confirmation into a trade to make sure everything is just right before stepping in. If you're a conservative trader, my suggestion is trade long when the green line is rising above the 50, when you're into positive sentiment. And when trading short, look for that green line is falling below the 50 line. This is where you're into negative sentiment, where short sellers are selling. Now, if you're an aggressive trader tends to jump onto a trade when there is a rise in momentum, when there's a strong push in the market. So as an aggressive trader, trade long when the green line starts to rise above the 32 level. And look to trade short when the green line starts to fall from the 68 level. When you take a look at the RSI price line, which represents current market sentiment in comparison to price, you're going to find a little bit of difference. You will find there will be times where price continues to move in a direction, but sentiment starts to fade, starts to turn in the opposite direction, literally starts to diverge from price. So the TDI Pro is a great tool to use to determine potential turn in the market. It also is a great tool to let you know that the markets continue to go in that direction. Taking a closer look at this chart, you can see that when price starts to rise up, it reaches a peak and then pulls back and then pushes up higher. Down below, though, you can see that we're well above the 68 level, so we're into buying exhaustion. There's a potential that buying will slow down, that there'll be a shift from buyers into sellers as buyers start to exit their positions. And we can see that the green line rises up to a peak, pulls back, then rises back up to a lower peak, and then falls back over. You were made aware of a shift in the market before price showed it up on the price chart. So this is one of the ways to use the green line as you trade, is to compare it with price. And one of the basic principles of trading with the TDI Pro is when price and market sentiment are aligned, then we look to trade in the direction of price. But when price and market sentiment are diverging from one another, look to trade in the direction of sentiment. The trade signal line, the red line, identifies areas to enter and exit a trade. The trading rules for the trade signal line are simply this: when the green line is greater than the trade signal line and both are rising, look to trade long. Look to trade short when the green line crosses below the red line and both are falling. The market baseline identifies overall market sentiment. This is the prevailing sentiment in the marketplace, the prevailing attitude of traders in the market. As a conservative trader, trade long when the green line is above the market baseline. Trade short when the green line is below the market baseline. And preferably in both situations, trade in the direction of the market baseline. As an aggressive trader, trade long when the green line is rising and the market baseline is flat or rising. If trading short, look for the green line to be falling below a flat or falling market baseline. The market baseline also does a great job of identifying market reversals. When it rises above the 68 level and fades, or drops below the 32 level and rises, that is a potential turn in the marketplace, literally the start of a potential reversal. I recommend to look for this on a 1 hour, 4 hour, or daily chart. If you're catching a large reversal, they're going to show up typically on the larger time frames. The volatility band, represented by the two blue lines, identifies increasing and decreasing volatility. What is volatility? Volatility is market strength. And when you place a trade, you want market strength with your trade. You want to be stepping into a trade when the market is basically putting on the gas. You don't want to be entering a trade when the market is falling back or fading or waning. It just can't seem to get going. So when trading with the volatility band, you want to see that the two lines are expanding or moving apart from one another. That shows increasing volatility. Whenever the two lines start coming closer together, the band starts contracting. That is when the market starts to wane a bit, starts falling into what we refer to as a range. So when you look at price action up above, and you can see that it's in a tight price range, look down below and you can see that the volatility band has contracted down into a small sideways range. We'll look for the green line to show direction of market sentiment, and then we'll look also for price to follow. There are times when there is an important news announcement. Oftentimes price will make a strong move at the time of the announcement. In this case, keep your eye on price and watch to see that the green line is following the direction of where price is going. But at this point, you'll note that the market is in a tight little range I refer to as a squeeze. When the market squeezes down, we're looking for a breakout. Oftentimes I'm asked by traders, when do I add to a trade? Well, the volatility band has some trading rules which will show you when to add to a trade. When the green line starts to rise above the upper volatility band in a long condition, you can add to your long trade. And just the opposite, when the green line drops below the lower volatility band and not down below the 32, you can add to your short. Also, when the green line starts to turn back towards the 50 level, starts turning back towards center and crosses over either the upper volatility band or the lower volatility band, known as the TDI hook, this is where you can exit a trade near the top of the move or near the bottom of the move. Well, that concludes the structure of the TDI Pro. Make it a great day and get some good trades.